Sure. But going back to your question, Bernd, there's like thousands and thousands and thousands of tables. Like, you want to know when each table was updated? Like, but anyways, I think I know what you mean. So, anyways, welcome everybody. It is just after 6:30 a.m. on Wall Street, 3 hours before the open of trading, and it is time to get our global macro on. It's also a Monday, so we have to do our commitment to traders report. So let's go through it. We got to look at the long term. We got to look at the short term. We got to put it all together into a trading thesis, what we call bias. And so there are many pieces to or there's a lot of nuance to what we do. Sometimes it's just very, very basic quantitative. One GDP is better than the other. But sometimes we have to see, well, is there a shift in the underlying trend? Is there a shift in the sentiment? Is it a seasonal change? Or is it a technical change and such? So there's a lot going on. There's a lot that we need to do. It's impossible or nearly impossible to do it piecemeal. So we automate it, and we call that QuantBox. A quant in a box. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Take a sip of the old coffee. Right, Burns, it's not every table. Yeah, well, that's the issue. It's like, well, can you tell me when the page is updated? Yeah, but there's no page. They're different views of multiple databases, right? So, anyways, I'll come up with something. Were you getting messages over the weekend by QuantBox? Do you get text messages and stuff? Oh, yeah. Yeah. Me too. All right. Yields 4.5. Hey, way better than 4.75, I say. Oil came down dramatically on Friday afternoon. We'll see if it stabilizes. Gold came down with it. S&P 500. In fact, I believe, aren't the European indices at like all-time highs? Like crazy, right? So S&P 500 well above 5,200. If this keeps going, 54, 5,500 are possible. Maybe even before the peak. Peak is usually Canada Day. And if you're not sure why Canada is, well, then never been Canada. Go north, eh? What else? Euro dollar just still again stuck 107. We've been there a long time. Yeah, sometimes it's down, sometimes it's up, but no trend there. Bitcoin recovering, sort of. I mean, it's hard. Well, I mean, look, it was 57,000, then it was 65,000. Now it's 62, 63. So, anyways. I know, Bernd. I'll look into it. But here when we look at this, let me zoom, scroll. Come on. There we go. This is the shape of all the different or many of the major stock markets around the world. And look at that. Look at the FTSE just screaming. Okay, Dow screaming, S&P 500. So remember that April was down 6%, and that was a very, very rare thing for April. But the recovery since then has been also one of the fastest recoveries. So CIA members, this is, when we had our conversations about hedging, I'm like, well, portfolio by construction is hedged. So the other response because we're traders. We want to, if it's falling, we want to be selling. If it's rising, we want to be buying. But that's not necessarily what you do as an institutional investor. And this is part of our conversations at the CIA. And I'm like, you could just keep dollar cost averaging if you could buy on the way down and just rotate, not overreact. And you can see, like, yeah, they all dropped, but they've all risen. Our challenge is we're traders, so we think like traders. We're also supermodels, so we think like supermodels. It's very difficult. It's very difficult being pretty. Um, mm, 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 mm. Right. So an institutional investor sees an assets drop 5 or 6%. They buy more. Why? Their investment thesis has been set based on hardcore analysis well in the past. There's no surprises. There's only dips. There's a difference, anyways. What's going on here? What now? We got risk on the monthly basis. Yeah, well, it takes a little bit of time. The big part of this, in my home opinion, is that GDP, GDP, okay, was down very significantly, and both ISMs were down. ISM services and ISM manufacturing. Okay, and so the idea is maybe inflation, which is later this week, will at least be flat. Let's say, how about not up? Maybe. I don't know if I buy that, but well, these things, as far as will the Fed cut or not? Well, with those economic reports falling or contracting, the answer is they could. And remember, we were thinking about maybe they can't, and then suddenly, with based on the economic report, suddenly they could. So risk on. Okay, look at the change in volatility over the last 30 days. Oh my god. Yeah. Sometimes with trading and investing, you look at things, you're like, oh man, I should have done X, Y, and Z trade. Well, the thing is, you wouldn't have known it then. That's why you didn't do it, right? But so there's a vol trade I've been eyeballing for almost a year now, and it pays really well when volatility falls. Um, but it's not the right time of year to do it. So, anyways, how would I know? But anyways, so volatility is down quite a bit, so that is good. Yields are flat, not good, not bad. S&P 500 is up, that's good. Yen is weak, that's good. Dollar, that down almost 1%. It's barely good. Okay, a weak dollar over the last 30 days. We're just kind of back to where we were, but that ain't bad. Gold's gone nowhere over the last 30 days, neither here nor there. So this is quite good. So it typically, we don't know if this is, the truth, but it's like this is what you go investigate. Is the dollar weak? Is the yen weak? Is the Swissy weak? Those are the normal responses to a risk on. Is the stock market going up? Is gold going up? Is Kiwi, CAD, okay, Aussie dollars, are they going up? Is the euro going up? It might. So you might look at like euro dollar long, euro yen long, and go investigate using technical analysis. Rick says, when I say good or not good, you mean in terms of risk bias? Well, let's investigate. Well, okay. So let's say you have a retirement portfolio Rick, and you're making money. Your portfolio went up and you are 1.9% richer than you were 30 days ago. How do you feel about that? Good or do you feel bad? Yeah, that's what I mean. That's exactly what I mean. It's good. But yeah, but that leads to risk on. See, this is a score, and how we get the score is we look at all these asset classes. I mean, they're asset classes, but the way I look at it is different trading markets, different constituencies of professional investors, for example. So gold traders, dollar traders, yen traders, stock traders, bond traders, vol traders, or and this is really an options play. So options traders, do they actually talk to each other? No, not really. It's so funny. Um, being humans, they block each other off. So when you used to walk into the Chicago Board of Trade, you'd walk in a door this way and you had like a soybean meal and a bunch of um, softs or something going on here in this room. I didn't spend much time there. And then you walk into this other giant room and you have the S&P 500 here and the S&P 500 options pit. The 10-year T note was here. And there's a bunch of other stuff I walked around and looked at. Um, and imagine they never actually spoke to each other. You know, imagine thousands and thousands of people shoulder to shoulder going through the building, slapping their badge as they go through it. And then they all get on the escalators and one at a time. Then they come out on the trading floor, and you're like, dude, you never talk to each other? Nope. You're like, maybe the S&P 500 go talk to the options guys because this is where basically you would get your VIX from. How much insurance are they buying against the S&P 500? And of course, these are just all orders from customers, right? And the 10-year T note here is like a Starbucks. It's it's funny. So, anyways, they don't talk to each other. But wouldn't it be neat if we could all watch all those trading pits at the same time and seeing, what kind of customer orders are these guys getting? What are they executing in the pits? And right now, the way that QuantBox is actually doing that and saying, well, the options traders that are buying options against the S&P 500, they're acting as if things are good and customers are saying that they're not interested in hedging their S&P 500 investment. So how do they feel about the market, Rick? If they're long the S&P 500 and they don't want to hedge it, they don't want insurance, how do they feel? Why would you cancel your insurance? Because you're afraid or you're confident? Okay, question mark is a fair answer. Yeah, you're confident. Cool. So I'm confident in buying the Aussie dollar. You see, it's a leap of faith, but go check it out. I might be confident in selling the yen. I might be confident in selling the dollar because that is usually what happens. Well, when these guys are happy. So then I go look at the next crew. Well, neither here nor there. Next crew, they're confident. Next crew, they're confident. Next crew, they're confident. Last crew, they're not. So I look at it, foursies. Okay. 4 out of 6 ain't bad. So I'm going with the flow. So I might sell, right? I might sell yen and buy Aussie dollar. So, going through a standard methodology, I could like zip over here, pop up my yens, go to Aussie and say, ooh la la, la 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 la. So it's going up and maybe making another high. So I have along here at 101 and a half. Okay, we're at 103, so I'm up 150 pips, and I could have spent last night preparing to buy this, or maybe tomorrow if there's a higher high. Okay, now I'm just doing basic technical analysis. Now this is the easy part, right? And that might be my destiny over the next 24 hours, and I'm done. Now, the thing is, I started with macroeconomic analysis. I am not guessing on that. Now, I don't know if Aussie yen's going to go up, but if it goes up, I can explain precisely why six different markets agree with me, or at least four different markets agree with me. Okay. Well, you're saying it doesn't. Okay, so your mortgage gets cheaper, your credit card gets cheaper, you can lease a car now. How do you feel about that? You're a small business and your cost of doing business has fallen, but your revenue streams have stayed the same. Well, now you just have more profit. How do you feel about that? I feel real good, right? Ba-da-da-da-da-da-da. Yeah. Well, or you're just more profitable, or just think of it as accessible. Last year you found your dream house, but you can't afford it with 8% mortgages because they're like, well, okay, so now you need 20% down, plus you need to have stellar credit, and plus you're going to pay 8%. So your mortgage is on this $500,000 house is going to be equivalent to $1 million house. You're like, $1 million house? I thought this was a $500,000 house. Yeah, well, at 8%. Okay. So if suddenly mortgage prices start coming, or more, mortgage costs, which is just another interest rate, it's just another yield. They're all related. So suddenly people can afford the home they wanted to buy last year, but they couldn't afford the monthly payment. So now the monthly payment is coming down, and that home will eventually become more accessible to more buyers. And somebody will actually show up and buy it because remember, somebody's trying to sell it, but nobody wants to buy it. It's too expensive. So, anyway, so the buyers and the sellers are both better off if the borrowing cost is better. So it's more accessible. Yeah. And projects get done, and that's why productivity will go up. So, like, when money was still free, excuse me, and a mortgage was 3%, I tried to buy a how big was it? 12,000 square foot house, 13. I think it was almost 13,000 square foot house. But it was a fixer upper. I mean, a lot, and even the loan that I tried to get for it was a construction loan. Like, can you imagine? Have you ever seen the Money Pit? I almost bought that house. Like, this house literally looked like it was 300 years old, but it was built in the early 90s. An incredible house, really. I looked at the frame is made out of steel I beams, not wood. Like, dude, like serious house. Um, but nonetheless, the construction loan was 4.5%, which was ridiculously high. What they do is they lend you money to build to fix it up so it's livable, and then they give you another loan, and then and all that kind of. So it literally like I was building the house from scratch, and so the project was doable, right? The project was doable. Imagine a slate roof. I had to like source slate for this this project. Anyways, long story short, when money was almost free, I could get this project done. If you try to do it now, there's just no way. Just because a construction loan is probably 11%, not 4.5. So that project doesn't get done, which means if I bought it, I'd have to have like I had to sand all the floors, I had to rebuild all the basement, had to replace all the HVAC, I had to paint 35 foot high ceilings, right? There's water damage. I had to replace the slate roof. Like, imagine all the workers. Do you imagine that? Right? You got to get someone to come in to sand the floors because some loser came in to the house when it was vacant and carved with a knife or a crowbar or something a scratch across the floor the length of a soccer field. So you're like, great. So now I have to resound the floor. It's like, what an a-hole, right? So imagine now you have to hire someone that, and they're like, imagine you phone for a quote. They're like, I need my wood floor sanded. They're like, well, we have a special if you do more than 800 square feet. I'm like, dude, it's like 14,000 feet of floors, right? That project doesn't get done if you can't get the loan. GDP falls. The money doesn't get transferred. The value doesn't get created. The home doesn't go up in value. You see, and this is all tied to something like, oh yeah, well the yields came down a little bit. What's the big deal? It's a huge deal. It's a huge deal. Okay, find rich countries with extremely high interest rates. You'll never find one because you can't get projects done. You can't raise the funding. In like America, like the best thing you can do is have credit because then you can go out and get projects done. You can go to a bank and they're like, dude, we'll lend you. Oh, we'll lend you money, sir. Thank you for the opportunity to give you money, right? And you go start doing things. That's why entrepreneurs are cool. You start buying old buildings, fix them up and increase the value and either sit on them or flip them or turn them into an income, right? That's just one of a million billion different things. But imagine factories don't get built, buildings don't get built, and therefore people don't get hired. And this is all because of something like the costs don't come down. Yeah. Yeah. Stock market doesn't go up as much if the cost of doing business is high. And that's all yield is. That's all. It's just a cost of doing business. So if cost of business is going up or stagnant, but at a high cost, it's very, very difficult to be profitable. So how could the stock market go up much if the stock market goes up based on their future expectations of profit? Well, if it's a struggle to be profitable, or God forbid the economy slows down, and maybe because of those high prices, because projects don't get funded, the economy slows down, and then now you're unprofitable as a company. That's very, very difficult on the stock traders. And so you'll see there's a relationship. And we haven't had a good correlation between the S&P 500 and the 10-year T-note in almost 15 years, I guess, whatever it is, since 2008, once the government jumped in and the central banks are buying bonds and the correlation broke down. We are moving closer and closer to more to reality. We're getting there where what we're supposed to see is S&P 500 and let's say the bond market moving in opposite directions, right? And we're not quite there yet, but someday, right? Anyways, good, good talk. Good talk. Yeah, it all matters. And once you really grasp the importance of these, like it's not like, oh, good, bad, good, bad. No, like there's real projects, real people, real assets that are involved here. So we're tracking the transfer of wealth around. Where is money going? Um, as traders and investors, the more we understand that and get a better sense of the magnitude of even small moves, the better we can invest our capital, right? So it's like not a trick, right, Rick? It's not, it's more like, oh my God, so this is happening and this is why we track it. Cool. So risk on, we might be buyers. We might be, but it's very helpful. So now you can go and look and decide, should you be a buyer of an asset or a seller? And QuantBox helps you address that question. After that, it's just easy technical analysis, right? Like technical analysis shouldn't be that difficult. Are you a buyer of gold? Yes, I'm a buyer of gold. Good. Buy a higher low. Done. Done. Yeah. So, but knowing you're a buyer versus a seller to me is the more interesting question. Okay. So we got PPI coming up soon. Yeah, that's our first glimpse. And because it's coming out earlier, um, it's going to carry a little more weight because we're going to use it to guess about Wednesday. Yeah. Okay. And then Wednesday's the main event. Okay. And there's more emphasis on this than normal. So let's talk about that for a bit. All right. Where it's expected that year over year CPI inflation comes down. Cool. What's the big deal, right? It's only 0.1. Well, tie that to a falling GDP and falling ISM and then falling inflation. That'll be heavily risk on. Okay. And if PPI falls, people are going to say, oh, this one's going to fall. Boom. And we're already risk on by tomorrow. But if this goes up, we won't freak out too much. It's expected. But if this goes up, very, very, very disappointing. You watch. If we go to 3.6, you're going to have a negative 2.5 day in the stock market. Like, for example, bloodbath. Because people will give up and they'll give up, and not just for May, but then there's no cut in June. And if this is trending up still, well, then there's no chance for September because we would need a couple of months trending by September and then the election. And then people are like, oh, they're never going to cut. And, it's so funny. The market's like a child. It's 6. They're never going to cut. No, they are. We're back on for 3. You're like, oh my God. It's frustrating, really, the market. So anyways, it's like if this goes up 0.1%, what it means is there's only one cut in December. It has a bigger magnitude of we're debating whether they're going to cut at all. 1, maybe 0 from this little 0.1. That's devastating to people. Traders are like, you know what? Give me my money. I'll see you next year. I'm going to go hide out in Mexico or South Africa. Try to be a yield hog, right? And you'll see a devastating move. I'll take if that happened, 0.1. What's the big deal? So one of my strategies, and I'm a T-bill and chill. I'm not actually T-bills. I'm in bonds, but I'm hiding out the 20-year part of the yield curve. You know, some people are hiding out in the 2-year, and I'm hiding out in the 20-year. But nonetheless, I'm hiding out, and that that market benefits when the Fed cuts. There's two parts of a strategy like this. It's not a big deal here, but it's a big deal here, and this is why I'm hiding out in that part of the curve. Um, Number one, I collect income, so now they pay me that money. Okay, Rick. So I'm happy with that because I'm lending the government money. And I'm the financier, and they pay me interest. Sweet. So we call that yield or income. But if the Fed cuts, okay, the value of owning the asset that is paying me the income goes up. So it's like owning an apartment building and I'm collecting rent every month. Cool. Now, if the economy improves, the value of the building goes up, not just the income, but right. So the value of the asset goes up, and we call that a total return. So now the value of the bond or bonds themselves that I own go up. Plus, I have that income. And so, I'm trying to get that. If the Fed doesn't cut, then the value of the asset is actually right? It's going to turn into a loss, actually. Yeah. I don't like that. The value of the assets, the value of the bonds fall. The bond market falls, and the yield rises. Okay. Yeah. Jim says still too. Yeah. Um, so anyway, so there are people in the market that are holding their breath. PPI, CPI today matters because if it shows that inflation is still going up, even with shrinking GDP, really, our manufacturing economy is actually in recession. I wouldn't, it's contracting, right? So you're like, oh my God, and non-farm payrolls, NFP wasn't good. So I put that on my list of why, people are betting that the CPI isn't going to be higher, it'll be lower. But if it's higher, it's a devastating. So I'll lose money on bonds. The stock market will fall. I'll lose money in the stock market, so on and so forth. Metals are overpriced. Oh my God. Money will move to the dollar. Because of 0.1. Really? Like, can you imagine you go to the restaurant and you like order a steak dinner and you're like, whoa, whoa, whoa. I was here like a month ago. I ordered the same thing and it's 1 penny more. What the hell's going on here? You trying to like rob me? Right? It's gone from $104 to $104.01. You're stealing out of my pockets, right? You're like, look at this crazy inflation. Yeah, 0.1. But it matters. The magnitude isn't the number, the magnitude is where the market is positioned and bet. With that being said, let's look at the COT report. You guys loving it? I'm loving it. Check this out. I got the white Tom Fords, with the matching watch. Oh, that's slick. Yeah, that's slick. Yeah, that's slick. All right. All right. I can't see. All right. Okay, gold. People still like the gold. Maybe inflation. They hate the Swiss franc. Yeah, they're cutting interest rates. Makes sense, doesn't it? And if we're risk on, we want to sell the Swissy, we want to sell the yen, but we also want to sell the dollar. And but it's tapped out somewhere in the middle. What we want to see, if you like being rich, you want the dollar to weaken. This is where amateurs and even media get this wrong all the time. Okay. If America is rich, then they don't do stuff themselves. They make poor foreigners work for them. I don't make my own t shirts, says America. So we'll have Honduras make t shirts. Great. Dollar leaves the United States, but shirts show up. Okay, cool. Now Biden's trying to lower inflation with his Inflation Reduction Act, and he's trying to clean the environment by subsidizing American production of anything green. Now, the interesting thing is he's about to put 102% um, tariff on cheap Chinese electric cars that want to enter the United States. Imagine you can buy an electric vehicle that produces no pollution for about $12,000. Well, that's in China money. So let's say $20,000 you can go buy a brand new electric car. America won't allow it. When I was in Spain recently, was it no, Portugal. I was in Portugal and I'm like, "Oh, it's a BYD store. Oh my god, you're not allowed to buy these cars in the United States." And the tariffs have gone from like 40% to 103%. So, if you ever wanted to own a car, but you didn't have a lot of money and you wanted a reasonably good car, apparently the quality is quite good and not be pollutive. The United States is blocking it. So that's inflationary. So you have a choice now. You can go out and buy a $70,000 Tesla, but you won't be able to get a $20,000, or let's say 25. But in China, they're selling for 12. You can get the short range one for 10 grand, brand new electric car. Well, why are they so cheap? Because they have slave labor? No, they produce more lithium, so their batteries are cheaper. They produce more of this, they produce more of that. So whatever. So all I'm saying is it's quite a uh, um, a, what is it? To say one thing and do something else. Contrast. Quite a they're blocking things like solar panels. Hypocritical? Yeah, too strong, but closer to that, right? Um, so if you want to produce clean energy and you believe in solar, I'm not so sure. I looked into solar. I'm not so sure that's the right answer, but it could be a contributing factor to improved environmental and energy. Okay, great. And if you've ever seen in China, they've invested so much money into solar, they have entire mountains completely covered. You can't use the land for anything else. And it's weird because it's science fiction. You have to Google it, like Chinese solar mountain, and all of a sudden the mountain, the entire thing, and we're talking about legit mountains, the entire mountain range looks like it's covered in black armor. It's just solar panels. And so they've invested so much money into solar that they can make it better and at larger quantities than anybody else in the world. You can't have it, America, because your government just blocked it. Like, but I thought we wanted cheap, clean energy. Nope. So, anyways, that changes the flow of capital around the world. I'm a capitalist. I don't like tariffs. I like free trade. So this is why we track money flowing. We want, right? Money flowing. Jim says geothermal. Yeah, the interesting thing, like in the part of the world I live in, if one of the things I looked at is geothermal for my swimming pool. Um, Turns out my house is sitting on solid granite because I'm up on a hill looking down on a lake. So after millions of years, the lake has gone everywhere else, but not on my part of the world. It's solid granite. So they're like, dude, we can't dig 6 feet down, or they have to go even lower that. And then what they do is cycle the water through that, and it keeps it cool, keeps it warm, keeps it constant. The funny thing is, then how did I build a swimming pool if my house is on solid granite? Um, Even the pool people are like, you can't put a pool here. Why not? We'd need like dynamite and stuff. Uh-huh. So, anyways, I built a pool in Impossible. It's in solid granite, no joke. In 1 million years, there will be a swimming pool shaped dip in this granite stone. Pretty funny. Uh, oh my God, $3,000 a day to dig. Yeah, but we built it. So, anyways, there are different methodologies to the environment. That's not what I'm talking about. I'm talking about, well, um, the sort of the consequence of the the proposal. It hasn't been announced yet, but tariffs of any sort is high inflation. And I've studied all kinds of examples at Harvard. We did it for different countries and different industries, and it always raises prices. The reason you trade with somebody else is it lowers prices, not necessarily because their workers will do it, for cheaper, but they can just do it better. That's through specialization, right? And so if China can build better solar panels and you want clean energy, but you don't want to spend a lot of money, shoot, what's wrong with, oh, it's Chinese. What's your problem? You racist? They're good panels, right? Do you want low, cheap energy or not? Do you want a clean environment or not? Yeah, but I only deal with certain people. Oh my God. See, capitalism doesn't think that way. Doesn't care the color of your skin or who you make love to. It's just like, good, let's do the best job ever. Let's increase productivity and let's lower price. Right? If you want a clean environment, that's a business opportunity, right? So, anyways, so prices for in the United States are going to remain high, which is inflation, if you don't want to do business with China. Reverse it. Why did we have no inflation for 25 years? We traded with China. Oh, you don't like low prices? No, I hate low prices. All right, well, okay. Yeah. So, anyways, there's an economic impact. And we're not I, we're not here to say good or bad. That could be the interpretation of what I just said. You're like, oh, he's saying this is good or bad. Ultimately, a tariff increases inflation. So now go make some money. That's the message I'm trying to get across. Okay. And now you can say, well, how do I make money with persistently high inflation? That's the $1 billion question. Okay. Now go get it. Now go do it. Okay. Cool. No diggity, no dow. So I was telling you, this recovery that we just had was really fast historically. Like we lost 6% and then boom, we're back. Like, and then look at this. There's 6% change in the Dow week over week. We lost 2,000 bears and gained 1,500 bulls. Wow. A 16% drop in bears, dude. Holy smokes. Now, remember, measuring something completely different, we saw a massive drop in VIX. That's options traders. Okay. Buying options to protect from a stock market fall. Not only that, money went into the stock market. Remember, they're two different things, two different groups of people. They don't even talk to each other. So the market went up and the options market collapsed. That's very risk on. Will it continue? I don't know, but these are big questions. Okay, money went into the Aussie, but check it out. Aussie is still a dog with fleas. It just had a big week. The way that I look at this stuff, or when I see something like this, my first thought is, oh, it's way up. I want to sell it. But before you get there, I mean, that's the right thinking. The market is heavily short and it rallied. But what's going on? And we lost 10,000 bears. Okay, that makes sense. And went up. Now, if there were no bulls, I would say, yeah, let's go in and look for a sell on the Aussie. But we do have bulls. So I have to be a little cautious. A 20% increase in bulls. Now it's heavily bearish, but a 20% increase in bulls. I got some battles to fight on Aussie. So I still would look to sell this based on the position, but I wouldn't be aggressive, in particular in risk on market conditions. But I could put this in the parking lot and save it for later and say, well, what about the days the market decides to be risk off? Well, I'm going to lean on this Aussie. Okay, so I'm going to put it on the victims list. Right? So right now we're all risk on. Everything's good, everybody. PPI comes out 0.4. Oh, crap. And suddenly now we're all risk off. Oh, good. Sell the Aussie. Yeah. Like, we're going to freak out over the smallest little detail. Good. So if we freak out to the downside, yeah, I'm going to lean on Aussie because it's still literally 70% bearish. So I don't want to buy it. I know it's going up. I see it. But I'm going to save it for a rainy day, an economic rainy day. What else going on? Okay, money went into some metals. Yeah, that's normal during persistently high inflation. Yen market is still very, very heavily short, which I am too. So that's interesting, but no real change. That's kind of how it felt, right? Like I think I shorted the yen maybe a week ago after the intervention, and in a week made, let's say, 150 pips per trade. But in these types of conditions, that's nothing. Even in a normal market, 150 pips on a yen pair is a day, not a week. So then I look at it and I'm like, yeah, all right. But what's going on here? Nobody's buying yen. In fact, we lost 5,000 bulls, but we lost a lot of people last week. They're not participating in the game. They're supposed to be shorting. This should be a positive number. Well, that explains it flat. But the market is getting thinner, isn't it? Okay, well, I'll tell you, if CPI comes down, so it drops on Wednesday, 0.1. These yen pairs are going to just skyrocket, just like that. Is my thought. Because if you remember the risk gauges, it says, well, in a risk on environment, sell the yen, buy the Aussie. Aussie yen goes up. Oh, look, I'm long on Aussie yen, which makes me a hypocrite here, but whatever. I'm not really buying Aussie, I'm selling yen. Right. So that would be quite an interesting move. I think both would react in similar fashion. And that's why the gauge says sell yen, buy Aussie. In those conditions, I understand why Aussie would go up. But I think it'll fall faster than it goes up in opposite conditions. Great British Pound, big recovery. People were gambling on a lot of different things, the Bank of England decision, but GDP was better. Yes. Actually, you know what, Bernd? I need to go too. I forgot about that. I have a meeting coming up. Um, so maybe. Now, this is older data. This doesn't include the improved GDP. Remember, if you have high inflation and rising GDP as a central bank, you can cut. If you have, right? So any right? If you have falling GDP and you cut, then you just create inflation. Maybe so. Anyways, I think people are making too much of a big thing right now in the Bank of England, but whatever. A little bit of money. It had a good week, and probably the next COT report would probably also be good, is my thought. So you might want to play with the Great British Pound, play with it like a cat plays with a mouse. You kind of bat it around a little bit and then ignore it, right? Wipe your whiskers. Okay. 50-50 on the S&P 500, and people are shorting. Remember, they're not hedges. Okay. Lots of bulls got out and lots of bears got in. Oil, we lost a lot of bulls, gained some bears. No. Well, there's a lot of risk premium play going on here, and it's hypersensitive to even the smallest little pieces of news. So we'll see what's going on there. Okay. Japanese stock market comes down. That brings yen strength, but right now yen is neutral. This is probably representing part of the intervention. Nobody loves the kiwi, but I think it actually went up last week. So if you want to look for selling opportunities on on your charts, well, we have 11% less bulls than we used to, but it went up. Okay, so at least put that on your hit list. That's how you're supposed to be using this. So what are you going to do this week? I don't know. I might look for a kiwi short. Yeah, that's how you do it. That's the purpose of all of this. And then your buddy says, well, what's wrong with the New Zealand dollar? Well, I think it's okay, but institutional investors are selling it. You know, I'm just follow I'm just following the institutional investors, right? And that kind of stuff. So and then 10-year teen note, uh holy smokes. What is this? 52 53,000 shorts. Well, I suppose that's good. I am a bear, and now it looks like a lot, though, right? But there's a million contracts short. Yeah, especially if you include my one or two contracts. I'm 0.00001% of the market, but I'm a mover, baby. Yeah. So anyways, the rest is yours. You got QuantBox. There's a lot to play with it. Just remember, well, we have inflation news Tuesday, and then the big one on Wednesday, and the small ripple. It's going to be like a butterfly effect. Oh, look at that. Butterfly effect. There'll be a tiny little change. It'll either be negative zero point 0.1, 0, or positive zero point 0.1, but it'll be felt around the world like a global earthquake. Okay. So I can't wait See what happens. I'll be here with you. Peace on earth. May the pips be with you. May your profits be above average. I'll see you soon. Cheers.